Most people building toward financial independence are counting on one of two things, the 4% rule or dividends. But have you actually run the numbers? As of early 2026, the S&P 500 dividend yield is hovering around 1.3%. That means to replace a modest $60,000 salary with dividend income alone, you would need a portfolio of over $4.6 million. For most people, that number doesn't just feel out of reach, it pushes the finish line back by decades. And that 4% rule, that assumes that you already have 25 times your annual expenses saved and ready to draw down. Neither strategy pays you today, and both require you to wait. But what if you didn't have to wait? What if instead of hoping your portfolio appreciates, you could put it to work for you right now, generating income every single week in bull markets and bear markets alike? On this episode of Escape the Clock, I sit back down with Brent Lindstrom, host of the Light-Minded Arts podcast, and someone who has done exactly that, to explore how stock options and futures can close the gap between where you are today and where you want to be, not as a gamble, but as a system. Tune in to learn how to stop waiting for your portfolio to pay you and start manufacturing the paycheck yourself. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom, having the option not to work. I'm your host, Daniel C. Rogers. In the world of personal finance, we are taught a very specific formula for success. Work hard, save your money, invest, and wait. If you make the right moves, then when you're 65, you can take Social Security, start withdrawing those retirement savings without fear of failing to pay the bills. But the finish line is moving. According to a 2025 Fidelity study, 70% of retirees say that the rising cost of living has already eaten into their savings. And a BlackRock report found that nearly 2/3 of savers are now terrified that they're going to outlive their money. With so many people looking to retire earlier and the costs increasing so much across the board, it's never been more important to have cash flow after that final paycheck stops. If you've read my book, Escape the Clock, and you've been following my show, then you know there are a few options to do this. For example, one strategy is dividends. You can use DRIP to build up a high dividend portfolio. Then you can redirect that cash flow to your bank account once you need it. That strategy can take a lot of effort and time. As of early 2026, the dividend yield of the S&P 500 is hovering around 1.3%. That means if you want to replace a modest $60,000 salary with passive income, you would need a portfolio of over $4.6 million. Now, for many, relying on dividends alone makes it impossible to support the target cost of living that we dream of. Instead of pushing back the finish line or compromising on that dream, what if you could stop waiting for dividends and start manufacturing them? Like me, today's guest leaned into stock options to do this. He used options and futures, not as a way to gamble, but as a way to generate a paycheck from his portfolio. Brent Lindstrom, welcome back to Escape the Clock.
Good to be back.
Brent, you were recently on the show and you were talking about your transition from a general contractor to a full-time filmmaker and an author. And in there, you talked about all these different ways that financially you were able to really break free of poverty, to be honest. And I think we might have mentioned options in there for just briefly a second. But now that we're going to go deeper here, can you talk a little bit about what that was in your success? Because a lot of people, when they hear the words, they don't think income. They think risk. They think anything at all. So how for you was it part of your story, and how did you help it realize that it could help you, be a valid part of your financial strategy?
Well, first off, I don't think that risk should be the four-letter word that everyone thinks it is. Yes, there is a degree of risk in it, but that's probably a good thing. So when I first started out my trading journey, I was first starting out thinking, well, I should be investing my money or I should be day trading. And so I was doing those a lot and I wasn't seeing any good results from them. And that's when I realized, if I'm going to do this, I need to learn a lot more about it. And one of the first things that got me into options, this was back in the days of Scott Trade. I don't know if you remember that one.
Yeah.
But I had a Scott Trade account. And when they asked you, do you have any experience in options? I said yes. And when I asked them, how much experience do I need to get the highest level of trading for stock options? And they said, well, you need 2 years of experience. And I said, well, I've got 2 years of experience. I didn't even know what the difference was between a put and a call at the time, but I got the account. I realized really quick that I didn't know what I was doing. And for a while there, I didn't do a whole lot. I still tried to do a little bit of the day trading thing with the stocks and maybe dabble with an option or two here and there. But it wasn't until I really got serious about finding financial income through my investing that I said, you know what? It's time to learn this. It's time to figure out what this whole world of investing is. How are people actually making money doing this? And why am I not one of them? I started really researching it a lot. I mean, hours and hours every single night. My wife would come home, she'd see me doing dishes, and it'd take me 2 hours to do the dishes because I'm more focused on the computer I got in front of me doing these things than I am on how clean the dishes are getting. And yeah, it took a lot of research, and it got to the point where I found basically my niche. The more you learn about things, the more you're like, well, maybe this strategy's better for me or this strategy's better. And it kind of depends on what your personality is, your risk tolerance, and what really just starts to click for you. And so that's how I got into both options on stock and probably even more so options on futures contracts and things.
Yeah, I can tell you that all rang very true with me. I kind of stumbled on it. I had been doing some swing trading, and then I realized, oh, this could be really lucrative for me. And there's so many ways to do it. Just like you said, you find the way that really works for you can be very comfortable. And then that risk thing isn't really a factor. I used to feel really uncomfortable with it early on. So I was like, oh, my stuff's going to get assigned. I'm going to lose it. I don't want to lose it. Then I realized, oh, what am I talking about? I can do this. So there's always upside here. I'm always getting ahead. I don't need to live in that fear. So I want to go much deeper here. I know a lot of people are interested in this topic. It actually gets brought up probably more with me than any other topic when I'm talking to people. Before getting into it, though, I don't think a lot of people have a deep understanding on it. So I want to start with a little bit of fundamentals. So bear with me for a minute. I want to tell a little story or an analogy here.
Sure.
Just to kind of describe, you mentioned calls and puts. So I want to just help people understand what those are. So as the audience, imagine you're all walking through your dream neighborhood. You see a house for sale. It's listed at $500,000. You're looking at this house and you have a gut feeling. Maybe there's like some big tech company being built, headquarters down the street, something like that. But you're convinced in just 3 months' time, the house isn't going to be $500,000. It's going to go way up, $600,000 at least. But you don't want to buy the house today. You don't have the cash or you're not looking to move, but you see this opportunity. So you walk up, you knock on the door, the owner's home, they open the door and you say, look, I'll give you $5,000 cash right now. In exchange, all you have to do is sign this contract to sell me this house for $500,000 anytime within the next 3 months. You're going to pay someone $5,000 for the right to buy that house for $500,000 later. Now, if the market goes crazy and it ends up worth $1 million, then they would have to sell that house to you for the $500,000, not for the million that it's worth. That's the bet that you're taking. The owner agrees that contract they just signed, that's called a call option. Basically, you're paying for the privilege of the upside. If the house price skyrockets, you use your contract, you buy it cheap, you pocket the difference. But if the market crashes and the house drops, let's say to $300,000, you're going to have to tear up that contract and walk away. It's worthless. You just lost your $5,000, but that's it. You didn't lose $200,000 on the bad house because you never owned the house. What you're doing is you're buying up. Okay, so that's a call option. Now let's flip the script for a minute because you kind of have to understand both sides of the coin here. Now imagine you already own the house. You are the owner of that house. It's your nest egg. It's worth $500,000, but you're terrified. You're hearing rumors of recession, factories closing. You're scared the value is going to drop to zero. So you go to an insurance company. You say, I'm worried. So I want to pay you $1,000 premium right now. In exchange, in the next 3 months, you have to buy my house for the $500,000 it's worth. And so they give a contract. And if the neighborhood burns down and the lot ends up worth nothing, they would still have to pay you the full price, that $500,000. They've signed that deal. That is a put option. You are paying for protection from the downside. So if the market crashes, you're safe. It's kind of like an insurance policy because you have a guaranteed exit. If the market stays fine, though, if it never crashes, tear up that contract, it's worthless. You lost that $1,000 premium you paid, but you slept soundly every night. That's called insuring the down. So this is how the stock market's doing this, right? There's millions of times every second people are passing these two pieces of paper back and forth, buying and selling options to one another. And so as you can imagine, if you understand this well, it can be an amazing source of cash flow. Okay, that's my story. I'll stop there. I hope that made sense. I try to want to make it simple for people because a lot of people do compare like buying options to buying lottery tickets. I do see that a lot. So Brent, you've been doing this a lot. Does that selling options to you, do you feel like it's a risky transaction? Do you see it as a sure thing of money? Like, how have you developed a philosophy around it?
I loved your analogy there, comparing it to a home purchase or a home sale. I mean, I've done that so much in the real estate market, and that's basically all it really is. And it's such a simple way to think about it. Can I piggyback off of your story for a second there?
Yeah, please.
So I do a lot of real estate myself. I've probably built and sold a couple thousand houses. And when you mentioned that, somebody pays me a down payment or whatever, maybe $5,000 for the right to buy this house, maybe the house is $500,000. They're going to buy it in 3 months' time for $500,000. If the price goes up, I'm always thrilled when they say, you know what, for whatever reason, I can't afford this anymore, and they walk away from it, and I get the house back, and I can now sell it for $600,000. I used to love that. I mean, for one reason, you keep the $5,000 that they put down as a down payment. To me, that is just like selling an option, okay? Because an option contract on a stock is the same as an option contract on a house like that. And actually, when I was doing that, that's basically a covered call on my end. So I own the house, and someone's paying me for the right to buy that if the price goes up or whatever, or even if it doesn't go up, depends on where I sell that call option. But yeah, it's such an applicable thing. And I think that when I look at the stock market, I don't see the risk in the sense that, well, I'm taking a big gamble. We have a saying in the real estate industry, and that saying is that you make all of the money at the purchase price when you buy the original investment. It's the same thing in the stock market. You make all of your money when you buy it, not when you sell it. Because when you sell it, you could be selling it for any number of reasons. One is you get a margin call. Maybe you have to sell it because you're panicking because it's not doing what you expected it to. Maybe you're selling it because an option contract came due and you got to get rid of it. But if you're careful about it, you know where you want to buy it, it's not that big of a risk anymore unless you can't afford the contracts you're putting together on it.
I talk about that in my book too. I'm a pretty risk averse person, to be honest. And I like the idea that the money I'm putting into this investment is money I can afford to lose in this investment. Therefore, I'm psychologically removed to it, that cost basis, the money I just put in to buy it. To me, there's so much upside with the gains, but if I have to sell it, even at a loss, tax loss harvest it, whatever, that's okay. There's still upsides there as well. So when you're going and doing this, when do you decide to sell let's just talk about calls for a minute.
Sure.
When do you decide to sell a call versus just selling shares? When are you trying to do one versus the other? And is there times you decided I should avoid options altogether and I should just focus on stock ownership?
So typically, I try not to hold a whole lot of stock myself. There's a strategy out there called the wheel, and sometimes I will pick up shares that way, but often I don't like to hold the shares outright. I try to do more option plays, and I'm not buying, like you said, I'm more on the income generation side of it. I don't want to be the gambler. I want to be the gambling house.
Yeah.
And so, yeah, I sell a lot of options. And what makes me want to sell a call option or conversely a put option, often I'll sell both. I'll do what's called a strangle.
I do strangles as well. Yeah.
Yeah, and a lot of times it's just a matter of what are the house odds. If it's likely to go up a certain percentage this way, and it's just as likely to go a certain percentage, the other way, the opposite direction, you can sell a call right above that or right below that. And if the odds are in your favor, and they usually are because these things are statistical things. I look at it as a statistical probability, then most likely you're going to be able to make money on that. Now, do you have times where the standard deviation doesn't really work out in your favor? Yeah, you do. But for the most part, trying to play it based off statistics, but also I like to add in fundamentals and technicals into that because oftentimes, and I'm sure you've been in this before, where maybe you will sell a call option or maybe you'll sell a put option and maybe you wanted to sell it far enough out of the money it would never hit.
Yeah.
And then it does hit and maybe it hits big time and you lose a lot of money on it.
I've been IV crushed before.
Yeah, there's times where it's like, well, how could I maybe have prevented that? And so learning a bit of technical analysis, learning fundamental analysis, I like to use both to help you kind of get a gauge for where things are and knowing that everything's cyclical and that certain markets are up at certain times and others are down and they trade places. And if you can maybe see it coming in one, you might know that the next one's about to hit. So there's ways to look at it and say, this feels a little bit safer. The statistics say 70% chance I'll make money, but add that in with these other probabilities and you can increase that to maybe 80% or 90% probability.
Yeah, I've learned that as well. Yeah, and it's just probability, right? Nothing's certain. I personally like the wheel strategy and I like strangles. Those are the two I do. I'll do leaps sometimes as well. But I want to get into a little bit of the basics first, and then we can talk about how these strategies help do what we're really looking to do, which is generate cash.
Right.
What we're talking about here is if you own, and we guess first we should define naked versus covered because there's a difference. Let's start with covered though. So let's say you own 100 shares of a company. You can cover those, meaning that that's something you own. Like you're good for that money. You're not borrowing any money. Nothing's happening there. Naked being like you might have a margin account. You're actually borrowing against it. You get called on that. You have to put up some amount of money to cover it. But with covered calls, you actually have shares. That means for every 100 shares, you can write a contract, one single contract. If you sell, that means someone's paying you premium that you're going to keep no matter what. But there is someone on the other side, right? Someone's buying something, you're selling something. So maybe let's start with the covered calls. So do you do a lot of those? And how has that been in your cash flow strategy?
I tend to allocate a certain portion of my portfolio to a lot of different strategies, and that is one of them. So I do covered calls. I do different kinds of covered calls also, and not just covered calls, but the flip side of that, covered puts. And a lot of what I'll do, though, is synthetic. And maybe that's too much for right now, but basically using other options, leaps and things to act like stock. And it depends a lot on where I feel like the stock is going, based off my, like I said, the fundamental analysis, the technical analysis, the market conditions as they are. I might sell a covered call that's in the money, at the money, or out of the money. Basically, if I just want cash and I don't feel like the stock's going to go down too much, I might sell it in the money. And so I'm just guaranteeing a certain return on my money. The same thing is as with an at the money one. So
maybe we should define a little bit.
Yeah, let's define that. Yeah, so say you've got $100 stock and you own that stock. You own 100 shares of that stock, which means you can sell one option on it. If you're going to sell in the money, you're basically selling a call option that is maybe worth $90, giving somebody the option to buy that at $90, which at face value sounds like, why would I sell somebody my $100 share for $90? But the thing is there's time decay on those options. So your option that you sold for $90 might be worth $10 plus that time decay, so it might be worth $11.
And the premium for taking that gamble is usually much higher.
Yeah, in this scenario, that would mean that if they end up buying it at $90 and you originally bought it at $100, but you sold that call option at $11, you lose $10, but you make $1. So in the end, you get $1 worth of cash flow out of that. You don't actually lose $10 because that's made up in the contract price. So that's how selling an in-the-money option works. It can go against you. Everything can go against you.
Right.
Just putting that out there. If you were to sell it at the money, then you're saying, well, I'm going to sell this option that I bought for $100 at $100 at some future time, and maybe you'll sell that option for, a $2 premium, so you collect $2 on that. And Maybe it goes up really high, maybe it goes down a little bit and you're covered for a little downside risk for $2 maybe worth of downside risk. But in the end, you're just trying to get as close to that $2 as you can. Now, if you want to play it a little safer and you don't really care how it fluctuates and you don't want to lose the money, I know a guy who has owned Apple since it was basically a penny stock, and he doesn't ever want to sell it, so he sells very far out of the money call options. Which means if he bought it $100, he might sell the call option for $200. That stock would have to double in the time frame that option comes due, and he might only make 5 cents on it, but he made 5 cents on it.
Probably a volume too if he has a lot of shares, right?
Yeah, and the further out you get, the smaller the premium. I mean, he might only make 5% on that, or he might even make less than 5% of a return on that. But if you can only get 4% on a CD and you've got some upside potential in your stock, you could actually make pretty good money doing that.
Yeah, I like FAR, OTM, or out of the money covered calls, but I typically have a lot more shares. I spent many years building a large portfolio. That's what I was doing. And because I have a lot of shares, I use volatility. I mean, like, what are we talking about here? We're talking about basically getting paid based on volatility or direction.
Yes.
For instance, I have a lot of shares. So I will be able to put out maybe 10 or 20, maybe 30 options if I want to. Now, if I got assigned on that many shares, it's a huge tax event, scary. So you got to be a little careful. There could be a black swan event. And who knows? What if the stock did double? Anything could happen. You never know. But if you push far enough OTM, the premiums are going to drop. The amount of money you're getting paid per contract does drop, like you were saying. But if you can do like 10 contracts or something and you're getting paid, like $100 per contract or something, which isn't bad at all, you're actually doing pretty well on that.
Yeah.
Especially if you're doing it every week. And then you can sell weekly options that way. And now people, hopefully their brains are lighting up and you can be like, oh, wow, if I was getting $1,000 a week and selling options and they expire every week and I just do it again, I'm making $4,000 a month. That's real cash. That's cash in your pocket. That's like a paycheck kind of thing. That's why this is so powerful. But people have to be aware that you can get assigned. That happens and it moves against you. You have signed a contract that obligates you to sell the shares at the price you agreed on. It's called a strike price. So if it moved way, 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 way further than what you set it out, even if you set it far out, you're limiting your upside that way. And that's okay, because the way I remind myself is you still had all those gains. Like, it was still upside. Like, at some point you just have to say a win is a win and be okay with it, not be greedy about it. But like, Brent, how have you personally handled the psychological part of this? Have you had that struggle with that?
So kind of what you're talking to there's a lot of companies that I would have loved to have owned back when I was first starting out. And it's like, well, I want to get a dividend from this. But at the same time, they either were paying no dividend or was like 0.25%. And it's like, geez, that can't even keep up with inflation.
Right.
But there's companies that you might really want to own. Like you say, you've got Google. And what does Google pay as a dividend?
Oh, I have this in my spreadsheet, actually. I can tell you the number.
I can pretty well guarantee it's not a lot, though.
No. I purposely buy dividend stocks that pay better, but they don't grow well, right?
Yeah.
Because the money if it's going into the dividend, then it's not going back into the company. So it caps their growth. So it's like one or the other. But Google's 0.47%.
Yeah, 0.47%. So if you hold on to that and you're doing it strictly as a dividend play, you are actually losing money every year. We're not talking about the price of the stock appreciating or nothing, because that's always possible. But say you're retired and you want a dividend, a lot of the stocks you might want to hold don't pay that great of a dividend. Maybe you love Google, maybe you love Microsoft, maybe you love any of these companies that you feel like are going to be around forever, but they're not really going to pay you anything. And anytime you hold on to it for appreciation and then sell it, you're diminishing how much of that you actually own anymore. But what really helped me kind of get over that hump was like, yeah, Google's maybe only paying, this much of a dividend, but I can make my own dividend if I hold Google by selling these covered calls. And you can make a safe 5%. I mentioned this in our other podcast. If you can't figure out how to make 5% a year, which is currently over what you can usually get as a CD at most banks, then you have no business being in this. But if you can make a 5% return each year, and you can do a lot better doing these covered calls, but you can do that pretty safely by owning this and making your own dividends. And I think that was probably my aha moment as to how selling options might be able to create cash flow. And, I've branched out to so many other strategies since then. But yeah, you can make your own dividends even if the company doesn't pay a dividend, and you can do it safely.
Real estate stocks have to pay dividends, and you can get some really good ones. I'm not making any stock recommendations, but just as an example, which is a real estate fund, pays a 5.77% dividend. That's really good, but optioning that isn't really lucrative. It's actually hard to get premium from optioning something that pays a dividend like that. But something like Google, even though it does pay a dividend, or even some of these companies that don't pay dividends at all, there's plenty of companies like, Netflix, you pick it, that don't pay a dividend. Well, you can create your own dividend just through the optioning there. And that's really, really great. And then you get growth on top of that. Now you're really getting double gains and you can do well. And there are cases where I will end up with stocks that aren't performing well. I can option them. And then even though the stock value is going down, I'm still making some profit. So I'm getting cash in my pocket. I'm actually minimizing the loss to the cost basis.
Yeah.
In some cases. And that's really great. So let's talk about the other side for a second. We talked about covered calls. You mentioned covered puts. I do cash secured puts as well. So if you have cash in your account, that means you can cover the opposite side, which is agreeing to buy 100 shares. So talk about how you do that in your strategy.
What I'll do a lot of times is sell a stock short or a futures contract. I'll do a leap or a synthetic short, which is doing the same thing but with options. But yeah, I'll sell short, which is basically you're borrowing the stock to sell back at a later time. And so that confuses a lot of people, but just know that you can buy a stock and you can sell it even if you don't own it. And it's pretty much the same risk profile, except that usually the market goes up. So if you're going to be short selling, you want to make sure you're short selling a company that is not going up with the market. It's more likely to be going down. But what I usually look at with those is, I'll sell it short if I'm doing a covered version of this, and then I will sell a put below that to capitalize on that. It's basically like doing a covered call, but for the opposite direction.
Yeah, the way I do them, we'll get into the wheel in just a moment, but one of the biggest reasons I do puts is because I actually want to own the stock. And I'm hoping to get it at a discounted rate while making premium on it. So there might be some stock I have my eye on. The market's been moving in some direction. And I go, okay, well, I would love to get it $10, $20 cheaper than what it is. And I'd be willing to buy at that price. And basically, I know I would buy it at that price.
Right.
And so I take whatever premium I get for that. And sometimes it can be quite good. Now, what happens is if the market doesn't move to that price or below that price, the contract's worthless. I just kept the money I made, the premium. I didn't get the shares. But if it does, in the worst case, it goes way below the price I agreed to pay. But still, I was okay buying it at that price. And I have to remind myself that, well, I'm getting the shares at the price I felt good at, and I got to keep that premium. So I'm already starting ahead in a way from what I had planned. So it is a good way to build up a portfolio by targeting stock, and you can make a lot of cash if it takes a while for a stock to dip to the price. Maybe it never goes down to what you want. But when you use these in combination, that's when we get into this wheel strategy, right? Where you put a put on something you want to get. Let's say you don't have a portfolio right now. You're starting out, put some put options out. Say, I might want to buy this stock. Eventually, you might be forced to buy it. You get assigned. Now you have those shares. And it's always 100 shares per contract. So now you can go ahead and do a covered call on it. And then, might be making money doing it that way. And you keep doing covered calls, but maybe eventually you get assigned again, meaning the price moved, past your number. Well, now you have cash back in your account again. You're basically turning shares into cash into shares. You can go back and forth doing that, pumping the premium out as you go. That's the wheel strategy. It's my favorite strategy personally. And I know you mentioned that as well. Is that one of the main ones you're doing?
No, actually, I don't do that one a whole lot unless the market is crashing quite a bit. So trying to remember a few years back, I was doing the wheel strategy with Google and Meta and different things like that. I was picking up Google at, I believe, $85 using that strategy. But then also, I was doing a lot of naked puts at the time too, because what I had done is I had gone through and done my fundamental analysis, and I'd set my put prices at the intrinsic value that I was happy owning those stocks at. And I thought, I'll never get these. But if I did, it'd be a smoking deal. So I actually sold naked puts out there to, well, they were cash secured, but yeah, I sold those out there and they were like 6 months in advance. And then the whole market tanked. And I was picking these things up for pennies on the dollars. And I'm like, I can't believe I'm actually owning these at these prices. And, I did that. I'd sell calls on them afterwards. And I ended up getting out of them all around $120. Kicking myself now. Why didn't I just do further out of the option calls and
Right.
collect dividends on these and ride it all the way up to where it is now? But at the time, I was doing a lot of that then. But also, one of the problems that I had initially there was that I was using my stock account as a piggy bank. And so I had investments in the real estate world that I still wanted to make that were coming due. And so I would have some of these great options, based on the will strategy that I was able to pick up. But then I would have to also sell them before I'd ever want to normally sell them so that I could invest in these other outside the market type things. And that's probably one of the hardest parts about the will strategy, or about actually owning any stocks, is if you move your money in and out, or if you have other obligations with that money, it's hard to time the markets.
I love that you brought that up. I actually think that is maybe the most important note to doing this right, is that you can't be dependent on it.
Yeah.
I learned that myself. I was like, oh, I need some cash here. If you ever feel forced to try to push for a larger premium or to do an option you're not feeling good about, you shouldn't do it. That's not the way to handle this, in my opinion. Like, if the markets are moving a certain way, there's a great strategy you can use to profit. It can protect your downside. It can profit on an upside. But if you're doing it because you need cash, you can get into trouble here.
Yeah.
So I'm so glad you brought that up. Comes to options, I think so much of it is understanding what you're looking at, right? Like, these things are being traded every day, kind of like the stock market. There's hours you can do these trades. And so it's not like you can do it 24/7. But when you're looking at it, like, you're looking at premium offered, you're looking at probability. There's this whole thing called the Greeks, which I guess we won't get into today, but a lot of people do look at things like Delta, they'll look at Vega, they'll look at all these things. And I don't want to complicate people with that, but are you doing other research? Are you looking at the stock? Are you looking at news? Or like, how are you deciding how to pick a strike price and if you're going to do an option?
So I like to follow a few people who spend all their time researching the markets and things, but that's more or less to give me some of the markets ideas out there for what's happening broadly. I don't take anybody's advice on pick this stock, pick that stock. I use a lot of that research mostly to just help me get a pulse on the market. And then for my own research, because I think you got to do your own, I do two different kinds. Like I mentioned earlier, I do fundamental analysis and I do technical analysis. For my fundamental analysis, this is for maybe if I want to do, like you said, a wheel strategy. I love intrinsic value. There's multiple ways to calculate intrinsic value, and I have a spreadsheet set up. So every now and then I'll go through my favorite companies and I will say, of the companies I'd want to own, these are them. I plug in all of their current financial information to my model and it kicks me out 3 different intrinsic value numbers. And then I take an average of those and say, I'd probably be happy owning it at that. And then I look at it and say, where's the market compared to that now? And if the market, which it usually is way above there, then I say, well, I'm not going to try to buy this stock unless it gets closer to there. And usually it only gets close to there for a lot of these really good companies when there's a financial crisis or recession. If it's not even 5% chance of it ever getting down to there, then I'll ignore it. The closer that probability gets to actually hitting that intrinsic value price, that's when I start considering maybe like a will strategy or a cash secured put on it so that I could maybe own it if it actually got to that point. And since the market is usually not there, I tend not to do a lot of the wheel strategy until that happens. My technical analysis, I do a few different things. I try to keep it fairly simple. I've only got like maybe 3 or 4 actual things on my charts that I look at. One of them is just the market waves. I don't know if you've seen them. They're just kind of like little cups that kind of go along the bottom of your charts. You basically find the bottom peaks of all of the stocks, and then you kind of set these there, and then you can kind of get a feel for when the market might have a dip in the future. And I'll use that along with the 9-day moving average and a 21-day moving average to kind of get a feel for where I feel like resistance might be and where bottoms might be. Oftentimes, I'll be able to get fairly close to timing windows on bottoms, and then I can use the moving averages, the 9, the 21, and then the 200 to figure out, is it about the right time for it to hit a bottom? Is it about the right price for it to hit resistance on one of those other levels? And if it is, then I will start selling puts, and I'll do naked puts on those at prices just below those. And usually, even if I get close to that, the price often rebounds back up. And those are probably my main technical analysis. I do look at IV a lot, so intrinsic value, and I look at a thing called a TTM squeeze and the MACD. So I do look at those also just to kind of get a feel for the trend and momentum. But those are my main technical go-tos.
You definitely have a very sophisticated approach, I think, more than a lot of people I talk to on this. That's really great. I do know, like, anyone who hasn't really seen this before, some of these probabilities are put right in front of you. You can see kind of a list of these things, and you can kind of start to push out further and further. You'll see the premiums change as the probabilities change. But, a lot of people will think, oh, 80%, I'd be comfortable at that. But like you, I'm looking at high 90% a lot of the time here because, I'm trying to keep premium with not getting assigned. I try to stay a lot out of the money. So if somebody was saying, look, you're doing all this research, why not just do a limit order? Why are you even bothering with this optioning stuff? Like, I could just buy it at that price and set it as a limit order. What would you say to them?
Mostly because I don't want to be an investor and I don't want to be a day trader. I like the investing side of it to a degree, but I don't want to tie up my capital because the market's always changing. Like I said, sometimes I do have these real estate investments that I want to be a part of that might have a higher return than something I might get in the stock market. And if I own a stock and currently the stock is down, I don't want to sell that at a loss so that I can go over to this other investment. So I like to do option strategies that are more short term, basically, that have the option of letting me pull out money if I need to for other opportunities that come along.
So we covered options here. I think people probably get it. You can make money doing these contracts on stocks. Let's actually shift and talk about futures a bit, because this is something you do that I don't do. I did write about it. I did research it. I talked to an expert when I was writing my book about it. And, I was learning a lot about this. And I think a lot of people think of commodities when they think of futures, things like corn or oil or whatever. But you're trading equity futures, right?
I'm trading all of them.
You're doing all of it. Okay, perfect. So can you explain this a bit and help us wrap our head around it?
Okay, so futures can be really tricky, but they can also be fairly similar to stocks. And it's like anything else, is they can be incredibly volatile. I mean, I was in the Dominican Republic 2 weeks ago, and you guys had this big cold spell that hit a big part of the country while I'm sitting there working on my tan or whatever. And suddenly my natural gas futures went up 25% in one day, and then another 25% the next day. And I'm like, I'm going against me. And so, that you can have wild swings in that, but you can have that in Tesla. You can have that in Nvidia. The thing is with futures, they don't follow exactly the same rules that stocks do. So if you want to own a stock, you can own that stock until the company goes out of business or until they get bought out. With a future, you're going to own that until the futures contract expires. You're basically buying a derivative, or if you're getting an options on a futures contract, you're getting a derivative of a derivative. So they both have expirations. And also, unlike stocks, the numbers don't quite line up. So if you buy an option or sell an option for a stock, how many shares is that?
100.
It's 100. It's always 100. If you do that with futures, it may be different depending on the particular futures you're doing. So let's just say you're getting a futures contract on the S&P 500. Yes, you can do that. They've got this one called the E-mini. It basically you're buying 50 shares of the S&P with one futures contract. Or they have an S&P micro contract futures out there, and you're getting 5 shares for every futures contract. It really varies. In natural gas, it's a different number. In crude oil, it's different. Corn, soybeans, lean hogs, they all have their own number of how many of this particular item that futures contract is worth. And to put it simply, because it's hard to think about a futures contract on, something like the S&P, but if you think about it with lean hogs, for instance, okay, so you've got this farmer, he wants to raise his hogs, he wants to sell them at market. So what he does is he sells a futures contract on these. He doesn't know what they're going to be worth in the future, but he knows that he's going to have a whole year of raising these pigs up to sell. And if he knows what the price is right now, he can at least lock in his profits. He can buy all his feed. He can allocate the labor he needs, transportation, whatever he needs to take care of those pigs. And he knows exactly what he's going to get out of those at the point in the future where the futures contract expires and he has to deliver those pigs. Okay, so he might say, I've got a futures contract. I need to deliver such and such pigs. That's taken care of. So that's what a futures contract is. And that works the same way with the indexes. But with an option on the futures contract, you're basically treating that farmer's future contract as a stock. So you can sell options on that. And that price of that futures contract, just like a stock, might go up and down. And you can play that with options the same way you would a stock. And that's a lot of what I do. And I do it on futures a lot because I have more of that short-term trading view. Whereas, if you're doing the wheel, it doesn't really work that way. I mean, it can, but you have to get futures contracts that are very far out, and they don't always trade very liquidly or very much at all. But where I don't really want to hold lean hogs, I want to just use the financial instrument to create a dividend off of that guy's lean hogs future. I can just play the options on those.
Is the closest comparison just doing naked calls and puts?
Yeah, it really is. It's naked calls and naked puts is probably the closest comparison, but there's a couple things that I really like about futures that you don't get in stocks. Probably the biggest on that is leverage. I do trade a lot on leverage, and you get what's called portfolio margin a lot of the times when you're doing a lot of this. You can get into big trouble with this too, though, because as we know, that fulcrum, when you're using leverage, the longer it gets, the higher you can get flipped off of that, right?
So if the market were to drop 1%, what would the impact be?
It kind of depends on if that 1% is normal or if that 1% is out of the normal range for that particular futures contract. It's just like Tesla. I mean, if you go into Tesla and you buy something that's, got a 5% probability, that could be what, a $70 price swing up or down, maybe even 100. Whereas if you go to Procter & Gamble, that same swing might be $20 up or down. It's the same thing with futures contracts. If you go into something like natural gas, which can have major swings, you can get pretty high up. And like I had natural gas go against me, like I said, 2 weeks ago, and it went against me by 50%. Like wow. 50% in the futures contract. And I lost a lot of money doing that, but I didn't lose my shirt off of that. I had my positions such that, I was able to weather that storm pretty well. And that's what you've got to do. Anytime you're doing anything leveraged is you really have to keep your positions sized appropriately for the amount of risk that you're putting on.
For sure. You have to cap it to some degree. So like with this, are there certain commodities you think are more stable or mature that like someone who is newer to futures could learn safely with compared to something like natural gas, which world events is constantly impacting?
Yeah. So I am a big fan of trying everything and learning as much as you can, as fast as you can, but keeping your position sizes small enough so that if you learn bad, you can weather that. But I would say in the futures world, doing something like the S&P minis would be a great one. That's one that I probably trade more than any. So if you have the option to look at futures contracts on your trading platform, for me, I use Schwab, and so it's /ES. Anytime that I invest in individual stocks, the individual stocks have big swings. If I invest in the S&P, it smooths out a lot of that. It can still have good swings, but it smooths it out. And so when you do a futures contract on the S&P, you get that smoothing effect that you would have in the stock market. So if you're familiar with stocks, it's an easy transition to go into there. But just keep in mind that every futures contract controls 50 shares of the S&P, which the S&P is a big fund in itself. Is it even S&P or is it SPX? In any case, it's a good chunk of money. And also, if you've got the portfolio margins on there, you're not going to notice the full effect of that on there either. You might feel like you're only trading $10,000 worth of risk because that's how much your buying power might go down. But really, you're controlling $350,000 worth of actual risk.
Well, hopefully you don't get called.
No, so you got to size yourself appropriately. And if you can't afford that, the micro S&Ps would probably be a better one to start with.
Well, Brent, this was so much fun. I'm really enjoyed this conversation. I do have one last question for you, though,
okay.
Because clearly you've gone through a journey learning about all of this. You way past me. I'm learning a lot from you right now. But like, where does it go from here for you? Is there other things you're now looking at getting into in the future, new strategies, new types of trades? Is there anything that you're like, okay, that's now off the table, make mistakes or something you've made that you're like, okay, that's a learning, got it. I should have avoided that in the first place.
There's there's so much to learn when it comes to the world of finance that it doesn't feel like there's ever going to be an end of things to learn. I think it's fun to learn about all of them that you can and to diversify because, what if the stock market does crash? At least I have real estate portfolios that are still generating income. What if the real estate market goes down? I have the stock market to rely on for some cash flow there too. I've got businesses, I've done a little angel investing, so I've got money coming in from those kinds of things. So it's all a matter of continuing your financial education. And like I said, I do art for a living. I'm spending a good 3 days a week, nothing but art, writing, filmmaking. A lot of this stuff I've learned in my spare time, and I can manage with only half an hour to an hour each morning. It's definitely doable, and even if my art doesn't ever make me the money I need it to, I have the financial security and the financial knowledge to be able to keep a steady living.
You're doing it right. You got a lot of stokes in the fire, and that diversity provide a lot of comfort. And it's really great that you're able to focus on your craft because, yeah, that's the stuff that makes a difference. But I feel like you're right. There's so many things in the world of finance, and I guess there'll be plenty of mileage left in this podcast as I continue to hopefully try to explore all those things.
Well, you don't need to learn it all at once either. I mean, focus on something till you get it good and get it right, and then move on. Because if you can spread yourself too thin too.
Absolutely. Like it's not just an academic thing. You have to practice it. You have to kind of focus it and you have to tailor it to you. Like all of these things are very personal. But anyone who missed that previous episode where you got to talk, you really should check that out. It was a really great, you talked about your journey, your financial transformation, all these other great things you do. I really suggest people check that episode out. But for anyone who missed that, how can folks connect with you and learn more about what you're doing?
Okay, so you can find me at lightmindedarts.com. I do a podcast called Light Minded Arts Podcast, or I've got my YouTube channel, which is coincidentally Light Minded Arts. On there, I do teach a lot about financial basics. I would love someday to get into the weeds like we've been doing here and to get even deeper because I love talking about finance, but I do keep it pretty basic for a lot of people there. And I just interview a lot of people also who are on their own personal journeys and hopefully helping others find relatable stories that can help them on their journeys to becoming working creatives and not just struggling artists also. So
awesome. Well, please keep that up. And thank you for being the first repeat guest on the show.
Yeah, glad to be here.
Brent has been on an amazing journey, from contractor earning $30,000 a year to managing a sophisticated portfolio that generates income month after month. What got him there was not luck. It was education, patience, and a willingness to learn things that most people never bother to understand. And look, I know this episode was quite technical at times, and it could have went over your head a bit, but I'd encourage you to go back and listen to episodes 28 and 29 from the archive. They were my introductions to the stock market and to stock options, and I think you'll see they serve as great fundamentals to the conversation that I had here today with Brent. Listen to those, come back to this one, and listen to it again. I think you'll find that it lands a bit differently the second time. And what I ultimately want you to take away is not some new trading strategy. This was really a conversation about mindset shift. Most people think about the stock market as a place where you buy something and hope that it goes up. What Brent taught himself and what I've learned for myself is that the market is also a place where you can manufacture income, regardless of which direction things are moving. Let's go back to that house analogy that I introduced earlier in the episode one more time, because I think it's the cleanest way to make this stick. If you own a home and want to generate cash without selling it, you could sell someone the option to buy it from you at a price that you would be happy to let it go. If the market never reaches that price, keep the premium, you never sell the house. That's a covered call. Now flip that around. Let's say you want to buy a home, but only at a price that you would be happy paying. You get paid to agree to buy at that lower price. If it never drops that far, you keep the money, never have to buy anything. That is selling a put. You name your price, collect the premium, and you only step in if the stock falls to where you already said you wanted it. Now, the wheel strategy combines both. You're not trying to predict the market, you're trying to be the house, not the gambler. You collect premium on the way down with puts and collect premium on the way up with calls. And you let the math work in your favor over time. If you already have a solid portfolio, you can start with covered calls. If you are building, start with cash secured puts at prices you would generally be happy to own. And here is what it looks like in practice. Brent told us that he spends 30 minutes to an hour a day on this. I spend about 2 hours a week. The time investment can feel heavier upfront when you're learning and practicing. And like he said, you start small, you build up, make a couple mistakes that aren't too costly, you get better at it, you master it. And once that workflow is dialed in, it becomes one of the most efficient things you can do with your time and your money. That is what work optional actually looks like, because the rest of the time, it's yours to do with however you wish. I'd love to hear where you are on this journey. Are you generating income from your portfolio yet? Or is this something that you're going to start working toward? Do you have questions about something we covered here? Email me at contact@escapetheclock.com, or you can also leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening, and best of luck manufacturing your own paycheck and escaping the clock. I'll catch you next week. That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. The book, the free planner, and the one-on-one time with me are all waiting for you at escapetheclock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.